Picture this. You're holding $10,000 cash in your hands right now. Feels like a lot, right? Here's the truth. Most people miss that money isn't worth what you think it is. And I'm not talking about inflation. I am talking about how that same $10,000 means something completely different depending on whether you're spending it, saving it, or investing it. By the end of this video, you'll understand why banks, investors, and AI see your money in ways you've never considered. Let's break it down. Let's start with what everyone thinks they understand. Purchasing power. According to data from the Bureau of Labor Statistics, the dollar you have in your pocket today only buys about 96.77% of what it could buy just 1 year ago. That might not sound dramatic, but here's what it means for your $10,000. If you had $10,000 at the start of 2024, you'd need $10,334 today to buy the exact same goods and services. That's a loss of over $300 in purchasing power in just 12 months. The average inflation rate has been running at about 2.9% recently, but here's where it gets interesting. Go back just 4 years to 2020. That same $10,000, you'd now need nearly $12,000 to match its buying power. Between 2020 and 2024, inflation averaged almost 4% annually, nearly double the historical norm. But most people stop here. They think, okay, inflation eats my money. I get it. That's surface level thinking. Here's what they missing. Your $10,000 is you aren't just losing value when you hold it. It's losing potential. Every day, that money sits in a regular savings account earning 0.5% interest while inflation runs at 3%. You're not just maintaining your money, you're actively getting poorer. Let me show you the math. $10,000 in a typical savings account grows to maybe $10,050 after a year. But with 3% inflation, you actually need $10,300 just to stay even. You're not ahead by $50. You're behind by $250. The purchasing power erosion is real, and it's relentless. But that's only the beginning of the story. Now let us talk about how an investor sees your $10,000. Because they're not thinking about what it buys today. They're thinking about what it could become. Author Don Ariely puts it perfectly in his book, Dollars and Cents. The opportunity cost of money is that when we spend or save money one way, it's money we cannot spend or invest another way, neither right now nor any time later. Here's a real scenario. You have $10,000. You can put it in government bonds paying 5% annually, or you can invest it in an equity index fund that historically returns about 8% per year. Most people think 5% guaranteed sounds safe. And they're right, it is safer. But let's run the numbers over 5 years. The bonds grow your $10,000 to approximately $12,835. Not bad, right? But the index fund, that same $10,000 becomes roughly $14,900. The opportunity cost of choosing the safe option, over $2,000 in missed gains. Now, scale that up. A recent analysis showed that an investor who put $5,000 annually into bonds earning 2.5% over 50 years would retire with $500,000. Sounds impressive in isolation. But if they had invested half that capital in assets earning 5%, they'd have over $1 million. This is how investors think. They're not asking, what can I buy with this? They're asking, what is this money preventing me from earning elsewhere? Here's where it gets even more interesting. Many investors use the S&P 500's historical 10% average annual return as their benchmark. If they can't beat that return, they question why they're bothering with a different investment at all. According to financial analysts at bank, this creates what they call a hurdle rate. A minimum return an investment must clear to even be considered worthwhile. Your $10,000 isn't just $10,000 to an investor, It's a tool. It's leverage. It's the seed money for potentially 100,000 or even 1 million, depending on time horizon and strategy. But investors still think in human terms. They balance risk tolerance, time, and emotional comfort. AI doesn't have those limitations. Let me take you inside how artificial intelligence algorithms view money, because this is where things get truly fascinating. AI doesn't see $10,000. It sees data points, patterns, probabilities, and optimization opportunities. According to research published in Mathematics Journal, AI trading systems in financial markets can analyze millions of data points simultaneously, processing information thousands of times faster than humans. In 2021, approximately 70% of total U.S. stock market trading volume was executed through AI algorithmic trading. Here's what that means for your $10,000. When you look at $10,000, you see a number. When AI looks at it, it sees historical price patterns across thousands of assets, correlation coefficients between different investments, real-time sentiment analysis from millions of news articles and social media posts, probability distributions for hundreds of potential outcomes, risk-adjusted return calculations across multiple time horizons. AI trading systems use something called neural networks, algorithms designed to mimic how the human brain processes information. They identify complex patterns in historical data that humans would never spot. For example, an AI might discover that when certain combinations of market indicators appear, say a specific movement in oil prices, combined with particular language in Federal Reserve statements, it creates a 73% probability of a stock moving up within 48 hours. But here's what makes AI fundamentally different from how humans or even institutional investors view money. AI has no emotional attachment. None. It doesn't feel fear during market crashes. It doesn't get greedy during bull runs. It doesn't care about that $10,000 being your life savings or your gambling money. To AI, money is purely a variable in an optimization equation. And according to IBM research on AI financial modeling, this allows AI systems to test thousands of what-if scenarios in seconds. Scenarios that would take human analysts weeks to calculate. Natural language processing algorithms can read and analyze thousands of earnings reports, news articles, and financial statements in the time it takes you to read a single paragraph. They extract sentiment. Is this news positive or negative for markets? And feed that data into trading decisions. According to MIT Sloan Research, sentiment analysis in AI systems categorizes market trends based on human language patterns, helping predict chain reactions in market behavior that humans might miss entirely. Your $10,000 to an AI isn't money in the traditional sense. It's fuel for an algorithm seeking maximum efficiency and probability-weighted returns. But there's a dimension most people never even consider, and honestly, it might be the most important one. $10,000 doesn't just have different meanings to different systems. It has different meanings depending on what stage of life you're in and what you're trying to accomplish. To someone living paycheck to paycheck, $10,000 is freedom. It's 6 months of emergency savings. It's the difference between a car breakdown being an inconvenience versus a catastrophe. To a retiree on a fixed income, $10,000 is security. With inflation running at 3% annually, they're watching their purchasing power erode in real time. That $10,000 needs to be protected, not maximized. To a 25-year-old just starting their career, $10,000 is potential energy. Invested in an S&P 500 index fund at a historical 10% average annual return. It becomes $174,000 by retirement at age 65. Without adding a single additional dollar. To an entrepreneur, $10,000 is seed capital. It asks the difference between an idea staying in their head and becoming a business that could generate 100,000, a million, or more. The point isn't that one perspective is right and another is wrong. The point is this: $10,000 is simultaneously all of these things. It's shrinking due to inflation. It's opportunity cost if not invested. It's data points to an AI. It's security, leverage, or potential depending on your situation. So what does $10,000 really mean? It means whatever you need it to mean, but only if you understand the full picture. If you let it sit in a checking account, inflation is eating it at roughly 3% per year. If you put it in bonds, you're trading growth for security. If you invest it in equities, you're accepting risk for potentially much higher returns. If you let AI manage it, you're optimizing for mathematical probability over human intuition. But here's the real lesson. Most people never stop to think about these different dimensions. They see $10,000 as just a number in their bank account. The wealthy, the investors, the institutions, they see it as a tool with multiple uses and multiple meanings. They understand purchasing power erosion. They calculate opportunity cost. They leverage technology and algorithms to maximize returns. The difference between financial struggle and financial success often isn't about how much money you have. It's about how you understand what that money represents. $10,000 is exactly what you think it is, but it has also so much more than that. If you found this breakdown valuable, hit that subscribe button. We're breaking down complicated money concepts every week, making them simple and practical. Because the more you understand how money actually works, the better decisions you make with it. See you in the next one.